Thanks for meeting with us today. Obviously, Bill's our guest speaker and going to be kind of leading the charge of our meeting today. I kind of wanted, obviously, someone else to be chatting regarding what's going on in the world of lending. So, Bill, do you kind of want to give us a quick update of what's going on?
Yeah, I can just hit on a couple of bullet points. Ever since the COVID-19 has happened, we've seen a liquidity crunch in the market. And so what happens? There's multiple things that have caused this. One of the big movers of the whole dynamics of the market was when the CARES package came out and the trillions of dollars that the government threw out there, and they told people that, if you're affected by COVID, all you have to do is contact your lender. You don't even have to put it in writing and you don't have to prove it. You just have to tell them, and you get to have a forbearance on your mortgage. Okay. And so they opened up a can of hornets like they don't even know what hit. And so that caused a liquidity crunch because all the people that are investing, like Fannie Mae, Freddie Mac, FHA, so they all have their own guidelines on what they do with that information. And who it really affects is the servicers of the loan. Because if all of a sudden somebody's closing a loan and then they say, well, I've been affected by COVID, so I'm not going to make my payment, and the government says I'm allowed to do that. So what happened was it caused a spike in rates. It caused a spike in points being charged. All kinds of bad things happen. So, it's almost like, it's the ready, aim, or ready, shoot, aim mentality. So in other words, the government didn't think about how it would impact us, right? You and I, our buyers on the street. They just came up with this idea, and that idea was god awful. And so they've already retracted how they're doing the forbearance and some of the guidelines. And this is ongoing. This is literally changing day by day, week by week, as Congress is meeting, and they're trying to figure it out. And now we're a couple months in, and it's still somewhat of a mess. But at least it's not as bad as it was. We were having interest rate swings of 1 and 1.5% in one day. Okay, literally in one day. And so crazy time a month or so ago. It is starting to settle down. But that just caused a lot of chaos. When the liquidity market gets in such a disarray, it causes the guidelines to change. So we've seen credit scores change. For a minute, jumbo products went away. For a minute, like right now, OFA loans, their rates or their credit score minimums are up at the 700. The minimum credit scores on some different loan products have changed. It's any of our non-QM loans. If you guys remember, I was doing for self-employed borrowers, we could do bank loans. Those are all gone. Okay, those are absolutely off the table. They don't exist. That whole market has basically shut down until after this crisis, and until they start to figure out, what the impact's going to be. And again, it just goes week by week at this point. But that's been the biggest thing that we've all been going through. And so we just have to maneuver the guidelines. And so when you give me somebody to talk to, we go through our normal pre-qualification process, but we now just have to work with the new guidelines and qualifying them. And so that is something that, is really important to be in touch with. Okay. So that's kind of the big.
Bill, can I interrupt you really quick? I'm sorry.
Yeah,
To piggyback on that, like, what is a standard, like, what's the low interest or low credit score for like an FHA or conventional or?
So, FHA still says 580. Okay. But nobody's doing 580s right now. Ours, we were at 600, we went to 620, and then we went to 640. That's still our guideline, but it's kind of case by case. So we literally have to go through and dissect the loan. If there's no payment shock and they have reserves, but they have a 630 credit score. I mean, so we're still making loans, but it's just not as automatic. Okay. Conventional financing, we still can do a 95 LTV at a 620 credit score. So that's just, and there's a difference between Fannie Mae and Freddie Mac on how they hold the lender accountable if somebody does a forbearance. Whereas Ginnie Mae basically just jams it down the servicer's throat and says, you're screwed. You owe us all this money up front. Hope you collect it on the back end someday. And so that caused a little instability on the government loan. It's settled back down now, but it's still, for a moment there, it was, you couldn't get an interest rate without 4 points. Okay, when this all happened, you literally couldn't get a rate without 4 points. And so it just caused some chaos. So
Bill, since there's such like a crunch on finances in everyone's life, and since interest rates are so low, are you seeing people sell back points, to jack their interest rate up a little bit in order to cover down payment or closing costs more? Or
you're referring to the lender charging a higher interest rate,
yeah.
So then we could then pay to reduce costs. No, it's very difficult to do that right now.
Okay.
That's called an over par rate. Over par rates are not happening right now.
Good to know.
Yeah, if anything, the norm is to get a good interest rate, you're probably going to pay a point. And you can even get an amazing better rate when you pay 2 points. So it's really, and again, that has to do also with the type of loan, the down payment, and the credit score. So it's just a combination of everything.
Gotcha.
That's a good question. Yeah, that's a good question. So another thing you had asked me about a minute ago was new construction. So I can talk about that for a second. I don't want to dive too deep because I literally could do a whole presentation for a half an hour on how we do a construction loan. But keeping in mind that if you have a buyer that is looking with a builder, there's two avenues for a builder. There's either the end loan, which is the builder gets the loan and the buyer gets approved up front. The builder builds the house, and then when the home is complete, then the end loan for the buyer goes into play, okay? That doesn't happen too often, other than maybe like your cookie cutter, Ryan Homes, K. Hovnanian, or Dries maybe. But if somebody wants to go build and they want to go buy a lot as a separate acquisition, and or some builders have the lot, Parkview Homes, for instance, they have lots in Avon Lake. We do construction loans for them. The buyer has to do a construction loan and they won't do an end loan. And that just means we provide the money for them, for the builder to build the house. Okay. And so the money is given to the builder a little bit at a time to build the house through the different draws and the progression of the completion of the home.
So it's just one loan.
Just one loan. We do one closing, and that's when the lot becomes the buyer's. And so at that point, we pay for the lot. Let's say it's $100,000. That $100,000 goes to the owner of the lot, whether it's the builder or a separate entity. So you can actually combine two different, like somebody could buy a lot out in Grafton and they have a builder from Wellington and they can build on that lot, and we close it one time. We disperse the funds for the lot, and then the buyer makes interest-only payments on how much money we've given out from the construction loan. So over a 4 to 6 or 8 month period, they're paying interest-only payments, kind of like a giant credit card. If you don't have much on the credit card, your payment is small. But then as we start giving more money to the builder, then the draw payments will increase over that time.
Is there a certain draw period? Like, does it have to be done by a certain time in order for it to?
Yeah, all that happens up front. We get that approved based on the builder's typical build time. For instance, K. Hovnanian, which I'm a preferred lender for, and they build in about 4 months. So we take the loan application and we close on the lot within 60 days. They have 4 months to build the home. We have some builders that take 6 months. I just talked to Parkview today. They're going to do a build and it's going to be an 8-month build. So our construction loan goes out to 8 months.
Wow.
Okay, we can do that. And if it needs to be extended, we can do that as well.
Is there, I was going to say, is there a penalty if it goes longer?
Usually not, but at that point, it's just something our secondary market has to deal with, because we do lock in the rate. When we do the loan application, that's the rate forever. So we don't, and that's the advantage of the construction loan, is the interest rate's getting locked. Like I'll take a loan application tomorrow and that rate will be locked for the life of the loan. The house won't be done until November. Their first house payment won't be due until January, but the loan is locked.
How does that happen? I'm sorry, I don't mean to like call questions and stuff. How does it happen if the building costs exceed the loan amount? Is it on the buyer, or can they redraft the loan, or is there any you know?
No, that
No.
doesn't happen.
Oh,
So
okay.
all that's determined up front. The appraisal gets done based on specs, plans, and blueprints. If they decide they want to add something after the fact, they're paying cash to the builder to do it. And it's not even hitting because we've already closed on the loan. The
Yeah.
loan is closed, that loan is set. And if they do any kind of modification after that, that is just a cash transaction with the builder. We can do construction loans. We can do an FHA construction loan with 3.5% down. We do a VA construction loan with a 0 down payment. And we can do conventional loans with as low as 5% down. So yeah, we have a great loan product, and our process and what we do is phenomenal.
Bill?
Have you guys been seeing more advertisement of Union Home Mortgage by any chance? Like crazy? We're seeing, we got all kinds of cool TV commercials. Bernie Kosar's done one. Anybody seen that commercial with Bernie?
That one.
Yeah. And you know, the sad part is we're a major sponsor. We are the official mortgage lender for the Cleveland Indians. And out in left field on the fence is a massive Union Home Mortgage logo, and nobody's even getting to see it. You know,
Yeah.
KeyBank is gone. It's us now, and nobody's even. You know, we're just like looking at it, going, "Wow, that's great." Nobody gets to even see it. So, and we were a big sponsor last year for the Browns. Does anybody know what PBR is besides Pabst Blue Ribbon?
Pabst Blue Ribbon, yeah.
Yeah.
It's professional bull riding.
Oh, well.
So think of that. We're the major sponsor for PBR, professional bull riding, because we've got a lot of offices out west, Oklahoma, Texas, and things like that. So we're a major sponsor. So if you watch CBS Sports during the week or on Sunday at 3 o'clock, there's actually professional bull riding, and you'll see we're the major sponsor. It's pretty cool. So,
Bill, what kind of loans, like what are the major common loans that you're seeing right now? Like what are like is it like 5% down, 20%, you know, what?
most common loans right now are conventional loans, 5% down. FHA loan, very common still. VA loans, a lot of veterans out there. It seems like we're getting more and more veterans in the area as people are, you know, getting out of the Army and the different military. So we're seeing more of that. We honestly, you know, I'm seeing less and less of 20% down conventional loans. You know, the money's cheap. So for people to put 20% down and use that to buy a house, it's just dead equity. So we're seeing less financial advisors that are planning that or recommending that. So, you know, it just seems, and with people with good credit, PMI is so low. I mean, it's amazing how low it is, and then it drops off. So we're seeing more and more of people keeping their cash.
Yeah, I mentioned that to almost all my clients when I'm meeting with them. They'll talk about putting 10% or 20% down, you know, and it's like, you know, money's so cheap to borrow right now. It just seems like a weird thing, you know.
Yeah.
Down.
Yeah, it is. So yeah, and usually I'll go over that analysis with people, and I'll say, well, here's what you said you want to do, but I just want to tilt your brain a little bit and think about this. And then they see that, and a lot of times they're like, yeah, why would I do that? You know, why would I put that much money down?
Is there no 3% down conventional loans anymore?
Yeah, there is. It's it's called a Home Ready is Fannie Mae. It's a 3% down conventional loan. There's an income limit on that, and it's like $59,000 or $58,960. So a lot of people just make too much money for it. So again, that's part of the process when we pre-qualify. We start with the funnel, and we just try to narrow it down to the couple of loans that person's eligible for, and then we show them the different options, whether it's a 3% down conventional or a 3.5% down FHA. Usually the people with higher credit and a lower income will put on a 3% conventional loan. The downside of that is the concession that you're allowed to get from the seller on a conventional loan. If the down payment's less than 10%, you're only allowed a 3% concession. And so a lot of times people need the higher concession. So then a lot of times we'll go with the FHA loan because you're allowed up to a 6% concession.
Gotcha. And do you guys do a renovation loan product at all?
Yeah, we actually have two renovation products. We have the 203K, which we have two separate ones. We have a streamline if the repairs are less than 35,000, or we have a full 203K if it's more than 35. But we all have for people that better fit. Again, we have Fannie Mae home style renovation loan. And so if somebody comes to me and they say, I want to buy a home and do a rehab on it, and my cost is 20 grand or 30,000, then I will pre-qualify them and see if I can get them on the conventional loan. Just a better loan product. Closing costs are less. You don't have to have, there's not as much red tape. You don't have to have an FHA consultant. So those are some benefits. And again, we weigh and balance and we give them the option, but it's usually pretty obvious which one's going to be better.
And that's a pretty streamlined process, right? You just have a contractor come through. You say you buy a house for 100,000. The contractor comes through, writes up a scope of work for 20,000. An appraiser has to appraise the house for say 130 or 140,000.
Yeah.
As long as that looks good.
Yeah, it's not as daunting as it used to be.
Yeah.
But you have to kind of have the right mindset. One, there's a lot of due diligence that the builder does or the contractor needs to do. We need an application on them. We have to vet them and make sure that they're going to be acceptable. We kind of want to have a resume on them to make sure that they're not just going to start a project and then disappear. So we like to make sure that we're protecting your buyer's investment as well as our loan product. But when somebody goes in with the mental capacity of knowing, hey, this is going to be a little extra work. I've got a contractor that's totally tuned in and he knows what he needs to do. It's really a pretty seamless process. But if somebody just watches HGTV and gets excited and then just goes and buys a house and just says, hey, I want to do a renovation loan like, Chip and Diane or Chip and with Joanne, sorry, or something like that, then, it's not as easy as they make it look on TV for sure. So.
Awesome.
Okay.
So you don't have questions for Bill? Any things
There's some questions out there, guys?
Hey, when do you think they're going to go back to loosening up the FHA standards on a credit score? I mean, have you guys even had that discussion?
Yeah, I'm thinking about if things just keep on staying kind of how they are, I would anticipate 30 to 60 days.
Wow.
I don't think it's going to be too long.
Okay.
Yeah. So just kind of the settling of the market, the liquidity market. Are
you noticing more fast appraisals, like where they're just waiving the appraisals, or is it like just?
No, it's something that they've come out because of COVID. We're trying not to do any. We're trying as much as we can to do no interior appraisals. So they have loosened that up. They've actually changed some of the guidelines, and if it's a refinance and it's not a cash out, then most of the time we're getting away with it. It really just depends on if it's a home that's priced accurately or not. If it's something that just seems way off the grid. I mean, there's so much data out there that when we run the buyers through our automated system, Fannie Mae and Freddie Mac, like on DU, it will tell us, hey, this is a appraisal waiver. So it's a PIW, it's called a property inspection waiver. And so then at that point, that's a great day when we can just let the borrower know, hey, it's only $75 for your property inspection waiver as opposed to, $425 for an appraisal.
Wow.
So yeah, we are seeing more of it though, for sure.
Yeah, I've noticed it lately too.
What else? Anybody got anything? I know, Eddie, you had some questions that you were gonna.
Yeah. I just figure. So if we don't have anything, I'm gonna kind of move into like a little question and answer game. So Bill will be the official. Make sure that the answers I have are right. And I'll keep track, and whoever answers the most questions, I have gift cards and whatnot for you guys. So our first question. What is the highest loan amount allowed for an FHA loan? Your FHA loan limit.
Is it 300?
Bill.
It's in the 300s.
10.
What is it?
310.
350.
I thought it was 355, so.
340.
317.
Why don't you tell us, Bill?
If he's under,
Bill-
he wins. It's like Price is Right.
$1.
Yeah. We should just-
$331,760.
How much, Bill?
31760.
Why is that exact number?
That's
Yeah,
the
that's really
government.
stupid.
Yeah, that's just the government.
There's got to be some sort of math behind it. There's got to be.
No, well, you know, it is like they'll set the bar somewhere, and then every area is a percentage of that bar. You know, so
Yeah.
Lorain County, Cuyahoga County, Medina County, Lake County, Summit County, all of them, Wayne County, 331,760 is the maximum FHA loan. Now, that doesn't mean you can't buy a higher priced home than that, because literally what that means is if you bought a home for like $344,000 and you put down 3.5%, that'll take you to the 331,760. And if somebody says, well, I want to buy a home for 350,000, but I need to go FHA, and we can do that. They just have to put a little bit more down to get to the base loan of 331.
Cool. All right. Next question. That was a little tricky, you know. So, what is the most you can ask for in a closing cost concession on an FHA loan?
3%,
I just talked about this. I
know.
just said this.
or was it 6%?
Yeah. Oh, nice job, James. Second time's a charm. 6%. James gets a point.
Woo!
Nice. All right. So the correct it's 6% you can ask for on an FHA loan, right, Bill?
Yeah, half a point because he had to do two answers there.
Yeah.
Right.
And he was so fast that he got two answers in the time that and on a conventional loan, just for, I mean, think what's the most you can ask for on a conventional loan?
That one's 3%?
There you go. James gets 2 points.
What? Hey, Eddie, how much is the down payment?
Bingo.
Oh yes, that's a great point. Yes.
That's it.
That's a trick question. That's a good point. Say it's they're putting 15% down. If they're putting
And it
15%.
would be, I don't know. I don't remember the answer to that one. I want to say it's, I want to say
2.
No, if it's Bill, do you want to answer?
Yeah.
it's
if
less
you
than,
put-
less than 10.
If you put 10% or more down, the concession on a conventional loan is 6%.
Mhm.
Yeah. If it's less than 10%, it's 3%.
That's awesome.
Yeah, very, very important to remember, especially on those lower loan amounts, you know, that 3% doesn't go very far when you have a buyer. That's why sometimes we'll jump over to FHA and go 6%.
I'm making these. I'm not doing anything else. I'm taking these notes so I can post this after. So, next question. What constitutes as a jumbo loan when it hits?
Really big loan.
I know.
Say.
What's that number?
550?
I was gonna say you're getting close. There's a 5 in the beginning.
500 or more.
You're closer.
575.
That's not closer.
5 million. 5 billion.
1 million.
Any other guesses?
I think it's 540.
Bill, do you want to tell everyone?
Yeah,
531.76.
510, 400.
Nice. And what is different about a jumbo loan? Can you go into that a little bit?
Yeah, a jumbo loan is, of course, over that. And a jumbo loan would not be considered a Fannie Mae or a Freddie Mac loan. So that's a non-QM, if it's Fannie Mae and Freddie Mac and that's below the 510, 400, then you follow those agency guidelines. If it's above and beyond that, then you're going to follow jumbo guidelines. Jumbo guidelines right now, you do have to put 20% down. It's just a tighter loan product. The interest rate's going to be higher. Closing costs are going to be higher. It's a tougher loan. Now, I will tell you this: if you go to different areas in the country, which we call our high cost loan areas, like if you go out to San Francisco and things like that, the Fannie Mae high cost loan is more than the 510, 400. Okay, so you can actually do a Fannie Mae loans. Same with FHA. If we go to different counties, but in different high-cost areas, which there are a handful throughout the United States, Fannie Mae has a higher loan balance that they allow.
Hey, Bill, how does that work if you have a construction loan?
Same, 510, 400. It's a maximum construction loan. If somebody buys and is building a $750,000 home and they want a construction loan and they're coming to me, they have to put down $240,000. Okay.
Does that include if they buy the land separate or if they just do the house, or doesn't matter?
It's all included in the loan. So again, it's just the loan amount. Now, if they own the land free and clear, that's equity. But if we need the money to buy the land, then that's part of the loan. Now, I will say there may be a bank or two out there that will do jumbo and their portfolio loan products, and they'll keep them, you know, so they might go up to 650 or 750 or something like that. So, you know, if I get a buyer and I can't do the loan for them, then I'll make 3 or 4 phone calls to try to help place them at a place that can do it. Okay, that's my job for you guys. I mean, that's my job. If you guys entrust somebody to me and I say I can't do it, let me make a couple of calls and then I can guide them and give them, you know, hand them off to somebody that I'm comfortable with.
Thank you.
Good question.
Yep.
Let's see if you were listening to Bill. What is the minimum credit score for an FHA loan?
Now or
580. 580.
40.
he said
Well-
640 earlier, yeah.
He
Yep.
goes 620 to 640, but I thought it was 580 originally.
Yeah, Bill.
It was, you know, Fannie or FHA's guidelines, they will post that 580 is the minimum score, but nobody's doing it. Okay. So it's a right answer.
I actually had Quicken Loans do one, shockingly enough.
Yeah. Right.
Really?
Recently. I mean, like how recent?
They closed on the house the first Friday of May, whatever date that was.
Okay. I
So
don't know if they're still doing those, but yeah, if Quicken's still doing them, then that would be where you'd want to go.
Yeah.
Yeah.
Cool. Good question. And Bill, just to clarify, you said 640 is yours.
40 right now is
Right now.
what we're doing. And again, that's our overlay. And again, it, like Mike was saying, that Quicken will do 580. So I happen to know, like the in-house lenders at Howard Hanna, for instance, they're at 680.
680. Holy moly.
Yeah. And what happens, here's how this works, guys. A lot of the mortgage companies, if they're not big boys in the major leagues like us, they have to go to somebody else for their money, where we have our own money, right? We've got our $100 million that we can lend and turn what we call our warehouse line. So we really establish those guidelines. But if you have companies like, you know, smaller mortgage bankers, independent mortgage bankers, they're going to go to like Wells Fargo, Bank of America, and they're going to get their money from them. Well, Wells Fargo right now, their minimum credit score on an FHA loan is 680. And that goes for everybody that was borrowing as a broker from them. Okay. Wow. At least that's what it was. Now, it may have changed, but that's where it was. So just recently.
Wow. All right. Pretty easy question. Do you need a pest inspection on an FHA loan?
Yes.
No.
No.
There's Scotty first on a no.
Boom.
Nice.
Okay.
No, you do not on an FHA.
You want the right answer?
Yeah.
Okay.
Damn it.
So it's a kind of a tricky answer. The answer is no, unless on the property disclosure, it shows that there was previous infestation from wood destroying insects. If the appraiser sees that, he's going to order a pest inspection and require it.
Good little.
That's a great question with a good little twist.
Yeah, that was a good one. I like that. All right. Let's talk about points. What is a point, and why does it matter in your loan? I know this was a tricky one.
It's a way to buy down the interest rate.
I will give that an acceptable answer.
That's a great answer. So I'll expand on that just a little bit. So points are a fee that you pay to get a better interest rate, but points are also a fee that Fannie Mae and Freddie Mac charge for different criteria. And basically what happens is there's a matrix. When we go to price a loan, we put in the credit score, we put in the down payment, we put in the type of loan, okay? If it's a refinance or a purchase or a cash out, how much down payment, and then you get points that are adjusted accordingly, okay? And those are called loan level price adjustments. Those come directly from the agencies. You could eliminate the points by just having a much higher interest rate, similar to what you were talking about before, Eddie, have a higher rate and no points. The way they're pricing loans right now is to get a real good rate, you're going to pay a point or two, and it's an amazing rate. Okay, so it's well worth it right now. It's well worth it.
What's the best rate you've seen just for that you got someone got to on a 30-year?
On a 30-year, probably in the twos.
Whoa.
Yeah, mid to high twos. Yeah, mid to high twos.
That interest rate for a 30. Oh my God. Wow.
So I'll be hearing from you tomorrow then, right?
Yeah. That's crazy. Let's see. How many days do you need from the issue of the closing disclosure to closing?
3.
Oh, Shannon Bird. I heard Shannon Bird first.
Okay, let me
Oh yeah.
expand upon that.
Yeah, I know. I should.
So what happens is when a loan gets approved, you send out what's known as the ICD. That's the initial closing disclosure. There's your 3-day clock right there.
Gotcha.
Okay. So the final CD can literally come out an hour before the people sign their papers and close. It's the initial closing disclosure that's required to go out immediately. And it's really kind of funny because it doesn't even have to be accurate. It just has to be a acknowledgement that the loan is now moving to closing. Okay. And what it usually represents is just the initial disclosure from the loan estimate. And then the final CD is done with the audit of the file. And that happens literally, I mean, I was working on a couple tonight for some that are closing tomorrow. So it's kind of it's a little convoluted on it.
That's silly. Like, why did they do that? That's, well.
You know, that was the Dodd-Frank Act, right? Dodd-Frank,
that was a huge deal when that happened. That was
Dodd-Frank came out and it rocked everybody's world, and everybody's like, how do we close if we're clear to close and we can't close because we have to wait 3 days? And then so we just kept working, you know, trying to figure out the loopholes, and now you can issue those when the loan has got an approval, and you don't have to wait till it's clear to close to issue them. So
here's another question. How is PMI calculated on an FHA loan? I know it's kind of tricky, but it's important to know, I think. It makes you sound smart. Doesn't seem like anyone knows. Bill, do you want to let everyone?
Yeah. So
Isn't it the same way?
No, it's totally different.
Yeah.
So, you know, the cool thing about an FHA loan and the PMI, and I tell this to people every day, is it doesn't matter what your credit score is, the PMI factor is exactly the same. You can have a 620, 640, 580 credit score. The PMI is exactly the same as if you had a 780 or 800 credit score. It's exactly the same. On a conventional loan, it is drastically different. Literally, you could have a $75 PMI compared to a $350 PMI for the exact same loan based on credit score. So on an FHA loan, it is whatever the price of the home minus 3.5%, right? That's your down payment. And then you just take that number times 0.85 and divide by 12, and that's your monthly PMI. Every FHA loan, it's done exactly the same.
You guys all get that? Come on, right? How did everyone not know that?
0.85 on the base loan, divide by 12.
Yep.
So I'm going to throw something in there. When does that PMI drop off on when does PMI drop off on an FHA loan?
Never. It doesn't
Everybody agree?
drop off on FHA, right?
Yeah, there is a twist on that too. If
Oh.
you put 10% down on an FHA loan, the PMI will drop off after 11 years.
Really? I've never heard that before.
Yeah. Why would anybody go FHA with 10% down? Why do you think?
Debt to income ratio?
Or to get more concessions from the seller.
That's a very good point right there. Not the debt to income so much, but the seller concession and, well, actually on a conventional loan with 10% down, you'd get 6% too. So I guess that's not really. But usually the only time that ever happens, one, if their credit score is low and the PMI is drastically high if you go conventional, and if you had a bankruptcy in the last 3, or once you have 2 years past a bankruptcy, you can go FHA, whereas on a conventional loan, you have to wait 4 years.
Oh, that was my next question. You totally beat me to that one. That was the next. So that was a good question. Yeah, can you say that again just to make sure everyone, because we're going to be heading into a time where foreclosures are going to start to become way more common than they have been in the last 5 years. So
that's right. So with foreclosures, the FHA you can do after 3 years, and the 3-year clock starts when the title is taken out of your buyer's name. Not when it gets sheriff's sale, not when they walk away, but when the title is actually taken out of their name. And some of you have probably heard horror stories about people that, my home was foreclosed on 5 years ago.
yeah.
Well, guess what? If the bank is still sitting on that and they never took it out of your name, your clock hasn't even started yet.
Yeah.
So, yeah, so that's a real kick in the, when that happens.
Nightmare.
So
I heard
that happens.
Of one of the worst stories I ever heard was something like that. And like someone moved in and they didn't realize that they didn't own the house and they bought it from someone and they didn't, well, I'm not even knowing it, but it was something crazy like that. So
yeah, so that's important to, we always dive, it's funny, we dive deep. When I talk to your people, I had somebody issued a pre-approval the other day, Quicken Loans, as a matter of fact, they issued a pre-approval on somebody that had a foreclosure 11 months ago. And they weren't on the loan, but they were the spouse who lived in the house, and that house got foreclosed on. It's not about the loan. It's about if you ever had a foreclosure, okay? And you had a house that had a foreclosure. That's the question on your application. And so they totally missed it because on the credit report, she didn't have a foreclosure, okay? But she told me, she goes, oh, my husband had a foreclosure a year ago, but I wasn't on the loan. And all I had to ask her, were you on the title? And she said, yep. And I pulled it up on the county auditor's website, and she's on title, so she had a foreclosure as well. So she's got the same waiting period. So
that's interesting. I didn't realize that. One of the last questions, I'll start wrapping it up because we're heading to getting late here. So what are 3 differences between an FHA and a conventional loan? A point for anyone that you name.
Credit score.
Credit score.
Down payment.
Nice.
The concession you can ask for.
Nice.
Amount you can borrow.
Oh, nice.
all good answers.
All good answers.
All good answers. Yeah, great answers.
We talked about another one we just talked about.
No pest control.
Well, neither one of them need pest.
I know.
PMI?
Oh, yeah.
PMI? Yeah. What else did we not say anything, Bill? Appraisal?
Appraisal and repairs. So you're going to need repairs on an FHA loan if the appraiser cites them. Not nearly as prevalent on a conventional loan. Does that mean there's absolutely no repairs required on a conventional loan? The answer is no. If the house has got a major deficiency, and like for instance, there's an active roof leak, the appraiser's there and it's raining and there's water dripping in the living room, that's a problem. Even on a conventional loan, that's a problem. So those would be things that would have to be addressed. But again, FHA is looking for safe, sound, and sanitary, and they're looking for a handful of buzz repairs, buzz points.
All right, I'm gonna do one more question.
Are you keeping score, by the way?
I am actually.
Okay,
That's why I'm like looking at my phone. I'm not actually like working. I'm actually like jotting down notes and stuff. My chicken scratch. Give me any difference you can think of between a VA loan and an FHA loan.
Zero down payment.
Zero down
for a
payment.
VA loan.
Pest inspection.
Pest inspection, yeah.
bingo.
Nice. Very nice.
Obviously, VA loans for military.
Yeah, nice.
Documentation required.
Oh, nice. What's the form? Bonus points. What's the form called for a VA that you need?
DD 214.
Oh, bonus points.
Woohoo! That's great.
Yeah.
Is there a shared driveway?
Oh, very good one, Mr. Soroka, as we've learned this week.
I know, yeah.
If you have
You
a
wanna
shared
share that?
driveway, you probably needed your shared driveway agreement.
Yes.
As we've learned this week, yes. So
And it usually has to be recorded.
that, yeah, like isn't it normally in the deed? Isn't this normally recorded way back when the actual driveway is put in? Shouldn't it?
Not necessarily.
Not necessarily.
No, because people can just have like an easement agreement with each other if you're a next door neighbor, and then it never can get recorded with the county or the city, right?
I don't know. Is a proper easement agreement actually recorded?
Yeah. Especially if the title transferred at any point, the
Right.
easement, yeah, it,
Would be included. So
right.
it's like is that something that the title company should find, or is it on the seller? Like, say it's in the deed, do you actually have to have like something written and agreed to between both parties on every single shared driveway? Do you know that?
That's a title question.
Title?
Yeah.
Okay, gotcha.
Yeah.
Jason,
Not
did
sure.
they specify, or was it just that case in particular?
Actually, it was the lender was the one that that required that.
Yeah.
And
So probably the survey showed a shared driveway, most likely. And so in order for the title company or the underwriter reviewed it and saw they're sharing a driveway. So at that point, who's paying for it? What if the driveway cracks and who's going to upkeep it? There's got to be some kind of agreement there.
yeah, title basically referred back to the original easement, and lender came back and said, no, you got to put an actual document in and have the new buyer and current neighbor sign.
The new buyer and man, that's great. I don't think I've ever remember having that. That's wild.
Hey, remember one thing, another comparison on VA and FHA is there's no monthly PMI on the VA loan. No monthly PMI.
I don't know if we've ever known that. Okay.
Yeah.
And there's no down payment. There's only the VA funding fee.
Correct.
Right.
And James already covered that.
Mhm.
Oh, sorry.
Yeah. James got that point.
Should have paid attention.
Take his points.
Don't give very many points. Don't short.
Yeah.
Recently did a VA loan and we couldn't charge them the buyer fee either. The Miller Williams buyer fee.
Yes, no office fees.
Oh, really?
Yep.
I didn't know that.
Say
Okay.
that again. What was that?
We couldn't charge them the buyer. We charge a $3.99 buyer fee and we couldn't charge it to them.
Yeah. Can't even charge the $199 Keller Williams fee. I remember that too.
Wow.
Yeah. That's
Interesting.
correct.
Isn't there a thing, Bill, on a VA where you have to dwell in the home within 6 months or something like that?
No, that's actually every loan. You have to within 60 days. You have to.
60 days. That's what it is.
Yeah. Yeah.
That's all the questions I had, guys. So
Who won?
I have it as James actually winning. I
No.
have
I never win anything.
James answered six.
Golf clap, Scott. Golf clap.
I had Shannon in second place with 4. Scotty with 2, Sarah with 2, Jason with 2, Rebecca with 1.
Oh, Sarah, if you had gotten that, if they had taken that point from me and given it
Hey,
to
I
me-
had 1, you bastard.
No, I have you at 2.
Oh.
Scotty at 2, Shannon at 4, James at 6, Sarah with 2, Jason with 2, and Rebecca with 1 of just answers that I heard that were correct. If you want to dispute, I don't care. I'll give you a gift card anyway. But anyone with 1, the 2 winners get $25 gift cards, and everyone else gets $10 that answered correctly. So if you want Starbucks or Giant Eagle, that's what I have them for. So let me know what you choose, and I will have them at the office or send them in the mail to you. So I appreciate it. Huh? Oh, or I can e-gift card them to you. Apparently, Mary is telling me that I'm not techie enough to buy e-gift cards.
I'll stop by the office one day. Don't worry.
Yeah, sorry. Cool. Does
You
anyone
barely
have,
got the meeting running, okay?
what's that?
You barely got the meeting running,
I know. I know. Crap.
Mr. Technology.
I know. Geez, these are such a pain. Like Microsoft Teams is a pain in the ass for the external invitation. So, but yeah, does anyone have any other questions for Bill? Thanks so much for meeting with us, Bill. I appreciate it. It's been really
Happy to be here, guys. Anything I can do, I'm here. And anybody have any last minute questions at all?
No, thank you, Bill.
yeah.
Thanks,
Thanks.
Bill.
Yeah, appreciate everyone coming. Thanks so much, guys. If you need anything, just let me know. Okay.
Awesome. Thank you.
Cool.
Guys, take care. Bye.
Yeah.
And just so everyone, I
Thanks,
have
Bill.
been posting the recaps and the team stuff, in our channels, so if you, I've been posting like little training stuff and recording it in Microsoft Stream. This one was about the actual training of Microsoft, like actually how Microsoft Teams works. So if you want, feel free to watch it. If you have questions or need anything, just let me know. Okay. Thanks for coming, guys. I love you. See you later.
See you.
Bye, guys.